All right, let's get to Kevin Green, as I promised, who joins me now for the data download. And obviously, we're getting the JOLTS released, state of the labour market, obviously with some other information that we got this morning, the initial jobless claims, the challenger layoffs. What's going on?
Yeah, good morning, Sam. We are actually seeing the JOLTS coming in a lot lower than the street's expectations. For the month of December, the number came in at 6.54 million. Street was looking for 7.2 million, and we did see a revision to the downside for last month's print, down from 7.14 million down to 6.92 million. So you are seeing the amount of jobs that are open really coming off fairly aggressively here. Now, that'll actually tighten up the labor market. It might be also a symbol and a signal that the labor market is weakening in some respects here, and that we might start seeing a supply glut of workers within the market. But a very interesting report when it comes to that particular metric. Now, that could also lead the Fed to actually cutting rates a little bit more. If we start seeing more labor data actually starting to weaken here, we had the initial jobless claims coming in a little bit more than the street's expectations. And I think the nail in the coffin would be obviously the jobs report, which we will get that at a later date because of the government shutdown. So very interesting report when you're looking at the JOLTS data just in general here. And we'll see if the market actually tries to bid this up in the event that we start to price in maybe one more additional rate cut for 2026.
Okay, so job openings are coming in a bit softer there, coming off certainly from November. It looks like it's been very much a trend over the last few months or so. Jobless claims also rising this morning, 231K on the headline, which was rising more than expected very much for that week, and continuing claims up as well. Challenger job layoffs, the worst since 09, 108K there. We know that UPS and Amazon have been seeing some big layoffs as well. So it doesn't look quite pretty out there for the jobs market at the moment. As you say, that could certainly feed into some of the Fed's expectations as far as the rate cutting is concerned. But let's just talk about these markets. Obviously, we're seeing the sell-off in tech continuing, down 1.2% right now for that sector. I'm just wondering, as far as the pressure that you're seeing, obviously you and I were breaking down these Alphabet, Google numbers yesterday. They look good. The market doesn't seem to be convinced so much right now. Walk us through what you're seeing.
Yeah, today's a little bit different than what we saw yesterday. We did see pressure in the S&P 500 as well as the broader markets, but the breadth expansion yesterday was actually very healthy. We had over 70% of the stocks in the S&P 500 in the green. Today, a little bit different. We only have 3 sectors in the green so far: healthcare, utilities, and consumer staples. So we are seeing a lot of defensive positioning taking place today. Even the high-yield dividend stocks that have been really on a roll here over the last couple of weeks are starting to actually pull back here a tad bit. We had the Google earnings and their announcement. The CapEx spend and their guidance moving forward was a lot higher than the street's expectations. So you did see that kind of put a little bit of pressure when it came to Google, and that's also going to have an impact when it comes to the communication services sector as a whole. And I think right now we are just kind of seeing a rotation now. That being said, volatility is now across that 20 level. It's sitting at around 21.84. We are now seeing this backwardation in the VIX volatility curve. That usually does not last for that long. So could we have more movement to the downside? That could be the case. I'm looking at 67.50 as our major area of support today, but we might be nearing the end of the vol spike here rather than the beginning. That's actually kind of the hope that a lot of bulls have in this market right now. So I think this is more of just a readjustment, realignment, lack of liquidity in the market. All of this is playing a factor in this sell-off.
Yeah, and then, of course, we look to Amazon later. We're currently trading down at 4.7 right now. In fact, all the Mag 7 members are in the red as we stand. So something to keep an eye on as we look across the memory space. A little bit of recovery in some names, not so much in others. We still remain under pressure there, and obviously software's continue to see that sell-off too. That seems to be the narrative in the market. Just switching over to what we've seen with some of these central bank moves this morning. No surprises there from the ECB and the Bank of England either, leaving rates unchanged. Haven't seen a huge move as far as currency crosses this morning either, as this was largely baked in. But they've been talking about how the economy remains resilient out in the Eurozone, and then obviously out in London, they've been talking about how growth has been holding up in the UK as inflation does persist, as well as to why they've sat on their hands here. Just talk us through the significance of that, what you're seeing as far as the moves here.
Yeah, I would say the Bank of England is actually probably a little bit more of an interesting move. So they did keep rates on hold, but it was actually a very big and split decision. We had 5 that voted to hold. We had 4 that wanted to see a cut. So we're pretty much right there. Maybe some economic data could actually push a lot of those that would like to hold rates, at least where they're at right now. Maybe some of the economic data is going to push them a little bit over the edge. If you look at some of the currency pairs with the British pound, you are seeing the pound weakening just a tad bit here, and we are seeing a little bit of volatility. For the ECB, obviously the economic data has been, for the most part, holding up. We did get an outlier report when you're looking at Germany. They had some production numbers that were really outsized, and that's because of the defense spending is starting to get reflected in a lot of the industrial data. So we have to be mindful of that. So it would be kind of like synthetic growth in some respects. It's really not showing up in other parts of their economy. And we also have our Fed and what we are going to do moving forward. So we did not see any type of major changes when it came to monetary policy shifts, at least for today. But it seems like everybody's kind of waiting for the data to really firm up and kind of show that rate cuts are needed. And for right now, over in Europe, it just doesn't seem like that's the case at this point.
Yeah, and look, the Aussies have hiked already to start the year, I mean, because of their inflation picture. And I mean, that's really been supportive of the AUD, the Aussie dollar, which has been the outperformer across the G10 currency space as well. And, you know, obviously a lot of market participants do look at the Aussie dollar as far as a global proxy here for economic growth, particularly with that exposure to commodities. So I suppose, you know, speaking of that, what are you seeing in the commodities patch today with this pullback in oil, this pullback in the metals once again, and we've got silver down 10%?
Yeah, I would say for the oil market, we are seeing a pullback right now because of these talks that are going to take place in Oman tomorrow. That's the hope, at least for now. We continue to see a lot of gyration when it comes to the geopolitical risk that's being put into the market. I don't think that we're over and done with right now when it comes to the oil move. It is still holding some key areas of support at this moment. If we're going to silver, obviously we had a counter trend rally. We kind of talked about this technical setup that was taking place over the last couple of days where we hit that 50-day moving average that was on Friday. A counter trend bounce was not out of the question. And if we look at that chart that we have, the one year daily chart, look where we kind of stopped out at. Right there at that 20-day moving average, you had some sellers coming in and stepping in right now. We are below the 50-day moving average. I would not be surprised if we actually pin and close at that particular level. And then we continue to try to figure out what is next when it comes to the silver move. Right now, it's still making a lower high at this point in time, so a little bit more bearish than bullish. But if you do get some adjustments when it comes to monetary policy, not only from here in the United States, but around the world, that could actually put another bid within the silver space right now. So unfortunately, we still got to get a lot of the froth out. There's a lot of retail traders that have never traded silver still kind of pushing prices around at the moment. You like to see volatility come in a tad bit, reassess the market, reassess the fundamentals, and then you are going to be able to have a little bit of a better gauge right now. So coming back, hitting the 50, once again, coming back and trying to hit maybe even the $85 level would not be out of the question over the next 24 hours. And then we have either a breakout, breakdown starting next week.
Yeah, I mean, trying to guess what happens next. I mean, it could be the next 5 minutes, KG, the way that these metals have been performing lately. But really appreciate it. Thanks so much for getting us across the data and the moves this morning. I'll speak to you later on.